Well, alternatives can be many things, including a monthly income opportunity. Peter Benson from Credit Connect Group joined me a bit earlier to talk about first mortgage investments. He assured me that while private credit has been very, big this year in particular, it's an asset class that has been available to savvy Australian investors for decades. So to start, I asked him to introduce us to Credit Connect Group.
Yeah, sure. It's good to be back. Nice to see you again. Basically, Credit Connect is a small public company, holds a little AFSL, and basically we're a mortgage fund. So we manage funds for investors that invest into a specific loan. So we tell them, we'll provide offer documents that actually tell them specifically where their funds are being invested. So that's what we've been doing. Credit Connect's been operating for 18 years successfully. So that's basically, a very, very snapshot what we do.
Yeah, they call that the elevator pitch. So let's get into a little bit more of the detail when it comes to, what exactly is a first mortgage investment? Because we hear so much about private credit, private debt. What's a first mortgage investment?
Well, basically, a lot of people, your audience predominantly will be sophisticated investors, high net worths, retirees, family offices, financial planners, accounting groups, etc., blah, blah, blah. So they all have money or capital to invest. But basically, if they go back 10 or 15 or 30 years, they may have had to have bought a property at one point in time, starting off. So let's just say 5, 15, 20 years ago, they bought a property. So they needed a 10% deposit to buy that property. And the bank actually financed 90% of the value of that property. So the bank's security was a first mortgage over that property. So years have changed. Obviously, your audience now has a bob to invest. This is what we now do. So we have numerous borrowers coming to us seeking finance, and the security and the concept is very similar to a bank. We're not a bank, obviously, but it's very similar, where we offer our investor clients the opportunity to invest into loans which are secured via mortgages on the borrower's properties.
Okay, we'll get into secure in just a tick, but so is this a monthly income stream? How does it work? How consistent are the returns?
Yeah, so we haven't finished our 24 financials at this point, but calendar year for 23, our fund, the Select Fund returned 9.4%, and all interest payments are paid to investors on the 10th day of each month, so it's monthly income. So if your audience, again, is seeking consistent monthly income, investing into our mortgage fund is certainly an option for them.
Okay, so maybe we should talk about the fund, because correct me if I'm wrong, but it's Credit Connect Select Fund is the name. What are the attributes of this fund?
Well, there's really two types of funds. There's a pool fund, which basically the manager has the discretion where to invest those monies, or there's a contributory fund, which is like ours, the Select Fund. So we tell investors specifically, your money will be invested into a specific loan, and that then gives your audience also the opportunity to do their own due diligence on a specific loan.
Yeah, interesting, because I did go to your website, and it's kind of fun to go and look and see what the actual properties are on offer and some of the attributes of them. So, maybe you could just detail.
Yeah,
like if you were to go to the website right now, what
you can
see?
Yeah, you can see a number of loans. I'll give you your audience a quick little snapshot. We had an industrial property in Kingsgrove recently. That property valued at $10 million, and we only lent $1.4 million. So the lending ratio was exceptionally low. And that was obviously a 14% lending ratio, and the return paid to investors on that was 9%. Have quite an upmarket property in Bellevue Hill. That property is valued at $23 million, and we lent $10 million on that property. So again, we've only lent to 43% to the value of that property. And one of the reasons I'm here in Sydney today is we're actually seeing a development group we've been working with for many, many years. They have a $66 million facility that we're actually doing, and it's 121 townhouses that have recently been built. So there's an array of, subject to your audience, the sums that they'd like to invest. There's smaller amounts, and there's obviously larger amounts. So we cater for numerous borrowers in terms of lending amounts.
Yeah, it sounds like a very big array of different types of properties. So does the type of property impact the size and scope of the returns on offer?
Yeah, definitely. There's different loan types. So you'll have a commercial property, you'll have a residential property, you'll have vacant land or residual stock, or you may have construction loans. So with construction, there would be a little bit more of a risk. So the risk is obviously rewarded with a higher rate. And if it's an established property like that one in Kingsgrove where the lending ratio was very, very low, obviously the return to the investors is a little lower also.
Okay, you just alluded to the fact that you are meeting with a property development group that you've been working with for a number of years. So they must be happy with what's on offer. I'm just curious how you balance the rewards and the service to borrowers as well as investors. I mean, is that a tricky balance?
Well, it is and it isn't. Again, we've been doing this a long, long time, and I'm not being arrogant, but you never get complacent, but we have been doing this a long time, and we do know what we're doing. So in terms of rates, we will always do a credit check on a borrower. We'll always obviously look at the location of the property. We'll always look at the lending ratio and the actual serviceability of the actual loan or the borrower's capacity to service the debt. So subject to what all that due diligence criteria meets, that's basically governed by the rate that we actually deliver to the actual borrower, which is then affected to the rate or the return the investor gets also.
So these are secured. These
Yes,
are secured loans.
all first mortgage security. Yes.
Okay. So what happens? What happens if borrower defaults?
Yeah, look, there's no point being in this business saying I've never had a default, I've never had an issue. If you had a stockbroker that had been in this business for 35 years like I have and said he's never had an issue or a problem, issues do arise. So first and foremost, our money is secured via a first mortgage. So we need to do our due diligence correct from the outset, ensuring all of our investor funds are actually secured. And more importantly, if a default does arise, it won't be subject to a loss. Now, a loss could basically mean, hypothetically, if we had $1 million property, typically we lend to 66% to the value of the property. So we've lent $660,000. The borrower defaults and we take possession to that property, and hypothetically we sell it for $500,000. So our investors have incurred a loss for $160,000. So what we do, we've had our own panel valuers for 20, 30 years, all independently valued. We have a very, very strict due diligence and loan assessing criteria in terms of looking at borrowers, looking at their credit ratings, looking at the locations of property. So just in a nutshell, defaults can arise, but the our Credit Connect Select Fund, has never had any loss of capital.
Okay. What happens if we start to see interest rates being cut by the RBA? I mean, it might not happen this year, but inevitably rates are going to go down from these levels.
Yep.
So how does that impact investors?
Well, I think, it's not a concern. I think if you actually look at term deposits now, all of the major banks, if you want to do a long-term term deposit, I mean long-term, 12 months, 5 years, the rates have actually lowered the returns on term deposits at the moment for a longer term period. So basically the banks, in a roundabout way, are saying we think in the foreseeable future, rates will go down. So if rates do go down, that means the person who has the term deposit, their return's going to be less. So most of our loans are governed by what we have a look at the rates that actually banks are lending at. And typically if rates did go down, our rates would also go down.
Okay. So I'm going to let you talk your book because we've got the details now. I think we understand what they are. What makes this, in your view, such a good investment and a good diversifier for those who are already invested in other asset classes?
I think it's an asset class that a lot of people aren't aware of. And if you put it in very, very simplistic terms, if you have an investor that has, I don't know, let's call it $500,000 sitting in the Commonwealth Bank or whatever bank term deposit it may be, in very, very simplistic terms, the bank may be paying on a term deposit now 3, maybe 4%. All the bank is doing with that money is lending it to a borrower. So what we're simply doing is saying to the investor, hey, in a roundabout way, you can become the bank. So we have the experience in the assessment and the context for the borrowers to continually come to us, where we can submit lending opportunities to our clients where they can basically double or in some cases triple the return they're getting in term deposits. I.e., if you're getting a 3 or a 4% return at the moment, our return, as I said, last calendar year was 9.4%. So it's consistent monthly income. On the 10th day of each month, your interest or the interest payment goes into our investor clients' accounts. And it's a very open and transparent investment. They know specifically where their money's being invested, which gives them the opportunity to undertake their due diligence, in respect to a specific loan. But I'm not a financial planner, the usual caveat, not giving financial planning advice. But again, this market is very unknown. There is a lot of commentary recently. Private credit is becoming quite popular. All I would say to your audience, if you haven't done it and you do have some skepticism, which is natural for the first time you've done something, invest a small sum. Just put your toes in the water, just get some confidence in it, let it run for 3 or 6 months, and then, this is quite good. And then that's what we've done with a lot of clients over the years. They've invested small sums with us, and some clients, some families now have 60 or 80 million invested with us.
Okay. When it comes to first mortgages, how have they historically performed? And you can talk through economic cycles, just to give us some sort of a sense of performance.
I think the majority of funds that have been professionally managed have actually, our fund itself, I've been through a GFC, I've been through, sorry, I'm that old. I went through 87. I went through that also. So mortgage funds, if they're managed correctly, are a great investment to get in, and quite typically, subject to what the market is now, the property is always valued in current market circumstances. And if we're only lending to 66% to the value of the property in current market circumstances, I'm not saying there is no risk but the likelihood of a loss being incurred is very, very low.
Okay, so just a starting point now, this is information only. This is not financial advice, but where would you suggest that an investor that's listening, and this has piqued their interest, where should they start to sort of start their due diligence?
Well, the main thing with us is we will have a specific loan. So I have as I mentioned before, I have a loan in Bellevue Hill. Mm-hmm. I have a loan now in Riverstone. Obviously, these are all Sydney suburbs. And I also have a loan in Queensland on the Sunshine Coast. So on our website, we have a number of current lending opportunities. So I would ask your audience, go and have a look on our website, have a look at those current lending opportunities. And then we can then send you, once they inquire, we can then send you further information about those lending opportunities. And typically those lending opportunities at the moment are paying a 9 or a 10% return.
Okay. I have been so engrossed, I forgot that we've got some viewer questions coming in. And this is from Andrew saying, have you considered investment in hotel? Okay, so are hotels amongst the properties that you would?
Yes, so as I mentioned before, we lend on all security types. Hotels we do consider, subject to its location, the lending ratio. Things about hotels is occupancy levels. We need to see occupancy levels and financials. So we do finance hotels, but typically only to a 60 or maybe a 65% lending ratio.
Okay. Kyle says, is there any way to access funds before the expiry date of the loans?
Unfortunately, Kyle, no. This is an illiquid investment. So the majority of our loans are actually invested for 12 months or 18 months. So once you, like a term deposit, if you go to the bank and you're putting your money into a term deposit for 6 months or 2 years, whatever it is, it's basically set and forget. So this is an illiquid investment, which in our offer document will clearly tell you what the term is. So your money is locked into that investment for that specific loan term.